Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about why a December rate cut looks more unlikely today and why national home prices are still so resilient. First, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. We have a very, very great topic to talk about today that's a little bit off keel. But before we go into it, I just want to add that it's Friday morning and pretty much like 6 Fed presidents came out and said, we didn't want to cut rates. We're not going to cut rates anymore. The labor market isn't bad. What are you guys talking about? They did a whole push on Friday on Twitter. Didn't really move the bond market too much, but Beth Hammack basically said there's nothing wrong with the labor market. Bostic and Logan and others were like, we're not going to cut rates. We're not going to do it, man. And Bostic even said, we're glad that Powell said that we're not going to cut rates. So there's this whole push by the hawkish people to say that the labor market isn't really bad. It's pretty much all, population growth, and it's not a function of demand. I was like, let's see, housing permits are in a recession, residential construction workers. Sarah, how many times have I told you this over the last 4 years? For some reason, the early forward-looking recessionary indicators from housing, in terms of the labor going down, they always miss because they keep on saying the current aggregate demand is good enough. And then it gets a little bit too late for them. They've done this in every cycle. You take COVID out of the equation, but what they're saying is what they always say before every recession in that context, right? So the labor data isn't breaking, right? But they need to see it break, right? And if it broke, there's linear economics. It doesn't just slowly break, it breaks, right? So I thought it was a very good day for those that believe in labor over inflation, that the labor market literally has to break in their face, because to say that there's really nothing wrong with the labor market at this point, that, the softness in payroll is, population growth, maybe tariff related, wow, on a Friday on Halloween, chef kiss again. These people are priceless. I love them all.
I think the other thing there is it points out that the Fed sees itself as a reactionary in this thing. And they even said that this summer, right? Like, okay, well, we'll catch up once it happens. They don't want to be ahead of the curve.
Beth Hammack was the one who really fought back today and said, I don't see, there's maybe some little slight softness in payrolls, but no, I wouldn't be cutting rates. We're barely modestly restrictive. She's really saying that we are neutral policy right now, that there should be no more rate cuts ever, right? Until the labor market breaks. So consistent. They are very consistent in that regard. So I thought it was a very good thing in terms of after what Powell did, all the other hawks kind of came in and did a joint force, on that. And this would run 100% in line with what they've done in the past.
So from your perspective, no December rate cut given what's happening right now?
There's too many people on the other side, I think. And if the labor data got better, trust me, I'm telling you, if the jobs data was just 40,000 a month, they'd probably go, we're not cutting. There's 40,000 jobs per month. That's, the population growth slowdown. We don't need to cut ever, right? In that sense. So they're trying to push the market. To me, that the bond market doesn't quite believe them, right? And again, every day that goes on, we're getting toward Powell's end. So it's interesting, but I was very glad to see all of them come out together and basically kind of reassess. The labor data isn't as bad. We're really near neutral policy, because that's what we've talked about with this Fed. There's a contingent of them that really need to see jobless claims break. And that's why Powell kept on talking about job openings and jobless claims, because those are the discharge data, the layoffs and all those things. And they need to see more pain before they take it from modestly restrictive to neutral policy, because we're not talking about an accommodative. That's a whole different subject. When that day comes, all of us will be having a different conversation. We're not there yet. We're just still modestly restrictive.
And I know you've been pointing out those two data lines forever, that they're looking at those two labor data lines. But it's ironic that right now they're saying that when we don't have a lot of federal national data for jobs.
There's enough data out there in the private sector to get an idea of what's going on. like we still see the state jobless claims. We still get to see private sector payrolls by like the ADP companies. And it's pretty much more of the same. But more of the same is not good enough. Labor market breaking. Okay, you people have to lose your jobs before they take it to that next level. Okay, so really right on cue. I loved it. Oh my god, like, another one. Oh, there's another one. Oh, there's Beth Hammock. Oh, there's one. So it was good watching all that. I think that reinforces our belief that they are going to wait until the very last second and then do it. But until then,
Okay,
modestly restrictive. That's just how they roll.
so they keep bringing up, the fallen population, right? That the population growth is the reason they're doing this. When you model it out, where should it be given
First of all,
population?
if there's more unemployed workers than job openings, take that population growth model out. If there's manufacturing jobs being lost since late 2022, take that population growth out. If there is, as Beth Hammock says, there's no demand destruction. If housing permits and starts are at a recession and you're losing jobs in construction, throw the population growth stuff out, because you're going to get stuck into you're going to get stuck in a variable that you cannot get yourself out of. This is why I stress to people, Jerome Powell and Beth Hammock both thought the labor market was great. And because they visually cannot defend themselves anymore, that the jobs data was negative and all these things, they were forced to cut. They did not want to cut, right? They were forced to, because the data was so bad that they have to. And what is our main talking point for years? They will wait until the very last second to do this. So very consistent on that. I've got a 73 to 78,000 because there are unemployed people looking for work, right? The continuing claims are very elevated for a reason. So please do not tell me the population growth is the only reason out here. It's literally manufacturing jobs have been lost since the end of 2022. And nobody talks about this. It's like all we talk about is we want manufacturing jobs to come back. It has literally been falling. Now, it's not a very big decline, but something's wrong here. And I think the big economist conference that was recently, like 95% of the people said like it was rate policy that is hurting the labor market, not population growth. You can make a great case about tariffs, but businesses don't want to make choices on labor yet. But also there's the aspect that that companies don't mind the labor market getting softer as long as they can keep growing, because they pay less wage growth. And the Fed's model, 3% wage inflation, 1% productivity, 2% inflation target. So their wage growth is still too high for them. They need Americans to make less. That's why they created that model. That's why we went labor over inflation at the end of 2020. So thank you, Fed members. Bless your hearts. You guys are great.
I think the thing that surprises me about bringing up the population thing is that's not something that just happened overnight. Like, if population is the way that they've been grading this for a while, why are we just now hearing this? This should be like, a 20, 30-year story if you're talking about population.
Well, they say that the immigration policies of Trump, kicking people out and having less people in, has brought the labor force growth lower, but that makes no sense with manufacturing data and housing data. Like, if construction workers were still creating jobs, that's okay. The AI data centers, okay, that's one thing, but that's not happening. We have unemployment rates rising. We have more people looking for work, and we have more people unemployed than job openings. Those are things that they've always told us they look at, and for some reason they just, we're not going to talk about that. But to a degree, I think Powell was forced to say that the labor market is deteriorating. Some of these other Fed presidents are just kind of doing their own thing, but it makes it a really interesting 2026 who the next Fed chairman is on that regards. But bless their hearts, they all on cue came out today. We were just like, labor over inflation, jobless claims have to break, jobless claims have to break. So people look at this, they're like, what's going on here? So you can understand why people think the Fed is political. Like, they don't think this would have happened under a Biden administration. They think the labor market getting softer, they'd be more dovish. I don't think that's the case. I think they really believe this, that they need the jobless claims data to get worse before they take it to that next level. And all we're doing is talking about modestly restrictive to neutral. We're not talking about an accommodative stance. That's a whole different ballgame. That means jobs are being lost and you have to change the ballgame. So we're just getting from modestly restrictive to neutral policy.
It's going to be especially interesting. Not only will they have a new Fed chair, but we're going to hear the whole Lisa Cook. The Supreme Court's going to hear or consider the Lisa Cook firing in January of 2026. So, depending on what happens there, we know Trump wants to get rid of all the people who disagree with him on the Federal Reserve.
Lisa Cook would be a dovish person. Part of the thing with tariffs is that the goods pricing is starting to pick up, and going out in the future, you're going to get more supply being under a tariff rate. This doesn't mean inflation takes off like it did during COVID, but you're going to get higher priced goods for certain things. And Trump saw this during COVID. Lower interest rates didn't matter what inflation, the economy was booming, right? Household balance sheets are still look good. So that's why he wants to get rates as low as possible. This whole we want to make interest payments to the government less. No, that's really not the case. But it is an interesting situation going into 2026 for many fronts.
Okay, so there's another topic I want to ask you about, something that we don't talk about a lot, which is home prices versus the growth in rents, right? What it costs to rent something. And tell us why that's important at this particular time.
So there's a data line called the OER rent. It's basically, with inflation and more people working, rents go. It's really rare for rent to have deflationary collapses because so many people are working. During the housing bubble years, the FHFA home price index deviated from rents. 39% was the peak, right? So that's a huge gap. And then the housing crash happened. But from 2012 to 2019, housing bubble 2.0, you all know who you are. We had so much fun in the last decade. But they kept on saying that reversion to the mean, that home prices are so far from rents that they have to come back down. So this group was 100% in the reversion of the mean thing. Never worked. And then comes years 2020 to 2024, which I'll talk about. This is biggest housing demographic patch ever. But unfortunately, inventory broke to all-time lows. Supply and demand equilibrium broke. Houses exploded out of control. Home savagely unhealthy. Adam Orzanek, who used to be the economist for Moody's, now works for Innovative America, I believe. He came out with these things on social media that, how do we fix this? How do we get home prices back to rent? And he's putting all these charts, and all these stock traders oh my God, they have to revert to the mean. So I've kind of left it alone. But today I said, you know what, I'm gonna address this. I go, it's not coming back like you think, right? Something really painful has to happen for that to happen. And he was like, why is this the case? Why won't it? Do you not think? I said, you need nominal home prices to crash, because there was a 39% gap at the peak of the housing bubble. There was a 60% gap at the peak of 2022. Now it's down to 49%. But if you really want that gap to converge, you need nominal home prices to crash in a very quick fashion, because that would be a deflationary collapse. So he says, you don't think it's going to happen? Why not? And I said, I showed him what it was in other countries. I said, look at these other countries. They're worse than us. And I don't think he's ever seen the price to rent, price to income, all those sorts. Man, Canada's horrible. Australia's horrible. New Zealand, France, the UK, they're all worse than us. But we have the better credit homeowner than they do. And a lot of them are tied to short-term rates. So a lot of people don't know this. Home price growth was much hotter in other places, but also we had the housing bubble crash. They didn't. So they're much more elevated than us because we were playing catch up on that sense. So the question is, how do you fix that? I said, it's what you originally said. You need something bad to happen, because housing is the cost of shelter to your own capacity to own the debt. It's a shelter cost. I don't look at it as an investment first. If you look at it as an investment, then you look at that chart and go, reversion to the mean, it has to come back down. People that look at housing as an investment first think price is going to lead everything, except supply is somebody needing another form of shelter, right? So it would have to be some crazy model that all these people sell their homes and they go rent, except the house cost that they have, a lot of them, 40% don't even have a mortgage. The others would be, rents would cost more than what their cost basis is. So that's just not how housing operates. So I had to throw all these charts up and try to explain to them that man, it is a lot worse over there, and this is a problem. But you could have real home prices, like my last 2 years of forecast, real home price declines. That can alleviate some of this, but what you're looking for is a nominal waterfall crash in prices. And over 80 years of history has shown us you need something really bad to happen for that to occur.
I also think, I mean, you can just have a mismatch in this, and that mismatch can get greater because, to your point, if you have a lot of equity in your house, and if you have a really low mortgage rate, if you don't even have a mortgage, like the fact that someone is paying less in rent means nothing to me as a home buyer or a homeowner. That I don't want to pay rent. I want to buy, and whatever they're paying, I don't even know what that is, nor do I understand why that would affect me.
There has been a lot of really bad economic takes on housing for the last 14 years, and it's the notion that homeowners act like stock traders. This is why I always talk about
Right.
it, because I always, me, Sarah. I want to debate everyone live. I want everyone's name and face and
Yes, you
forecast, and
do.
I want their children and their wives and everybody to know them. But I want them on record. And what's happened is that we've had so many. I still one of these days I want to figure out why is our most untalented Americans housing crash people, because the home is where you live, right? It really means something. So if you doom porn it, you could manipulate a lot of men into thinking that everything is bad as it should be. But these people are like big nominal national home price crashes because nobody can afford. The supply is in the hands of somebody that can afford, and they've lived in their homes for a very long time, and their wages grow every year, and their debt cost stays the same. That's why the 30-year fix was created for this. So now that we're in 2025, like, why haven't home prices crashed, Sarah Wheeler? Now that we've done this for 5 years now, why haven't they?
Because enough people can afford it. So you have enough people out there who that's the cost of shelter is what they can afford. That's what they're choosing. Has nothing to do with rents.
You know, one of the things I tried to explain to Adam, I said, we have one time in history where nominal national home prices crashed. And what were the variable components into that model was that you had a massive amount of inventory. You had a major amount, the highest distressed homeowners in the history of America. You had underwater mortgages. And like we always said, our new listings data took off. When our new listings data takes off, it's never a good thing. Something's forcing people to sell. Well, they were distressed sellers. Distressed sellers, this is key for everyone. Distressed sellers became a higher percentage of sales. So when you increase that in an underwater marketplace, naturally prices could really decline faster than what we've seen in the last 80 years. None of that is happening here. Right. So what do we always do here? Ever since 2012, I've kept everyone's national home price crash forecast. Right. And I was going to end this at, after 12, because we said a broken clock has more economic game than these people on YouTube, TikTok, and all that. But here we are in 2025, and there's the greatest sellers buyers gap in history of America and the highest percentage of cancellations. And so everybody was all in this year. And then when we looked at the Redfin data today, and the Redfin's home price index is accelerating a little bit higher than 2024 levels, and it's Halloween. It didn't work, right, for these people. So unless you get major distressed sellers, massive amount of inventory, it's very hard to get a velocity crash like that, because why would a
I
homeowner actually do this? So the supply and demand equilibrium was home prices or home sales peaked in 2005, home inventory was low, home inventory went vertical, home sales declined, and here come the wave of distressed sellers. There's your model, everyone. If you really wanted to model national home price, just do that. Very simple. Home sales crash. We had a home sale crash in 2022. But what didn't happen? Inventory didn't take off like it did back then. Inventory, total active listing was 4 million in 2007. Here, we're at 1.55 million. It's October 2025. We're at 1.55. The norm is 2 to 2.5 million. Distressed sellers, delinquencies, homeowners delinquencies rate 30, they're all near record lows. Back then, housing was breaking in 2005, 6, 7, 8. So you don't have to be an economist or a data analyst. You just put those variables into it. Here it is.
yeah.
This is your backdrop for a national nominal home price crash. This isn't it. And it's the end of 2025. And it's like, no, that's
In in 2022, when people were talking about how we were going to have all this inventory, we're like, please, please, somebody start selling silver tsunami. Or what was it? The Airbnb crash? Like we had 240,000 homes for sale in the entire country at one point in 2022. And you and I were like, if only this was right a little bit, that there would be some more inventory. But actually, we have the opposite problem.
So just to keep it simple, when inventory escalates, when new listings data escalates, when we have massive credit stress in the marketplace, we've had many recessions post World War II. We've only had one credit crisis. And then when pricing starts to get weaker and weaker and go negative, and the duration of that negative curve happens for years, right? 2007, 2008, 9, 10, and 11, years of distress, years of new listings data going up, right? That's the thing. That's a working model for a national home price crash. None of it's here. Right. None of it has been here. When it is here, we'll be the first person to know. So that's how you try to get it. And this is the savagely unhealthy home housing market I was talking about back then, is that I knew this is not an easy fix, and that it was going to be very problematic, that we needed higher rates, we needed inventory to grow. And the whole point was that we can take higher rates as a country, right? Just to restore some balance, because we're not the housing market of 2005. That was the article written in February of 2021. We can take it. We just need it now. And obviously it didn't happen until 2022. And it took rates getting to, between 6 to 8% to create that equilibrium balance. But so much better now, so much healthier. But to Adam's original point, how do we fix this? It's very difficult, because other countries are still, their price to rent, price to incomes, they're so much higher than ours. We're just like, we've just got into their early stages of breaking out before that. And they're just like, and then when people visually got to see like Canada, Australia, France, and the UK, they're like, oh my Lord, is it? I say, yeah, y'all think there's a problem here. Hey, Lord have mercy, you're not in Canada. Look at Australia. Look at all these. Those are really bad. So that's why there was this fear of home prices escalating out of control. When people kept on saying home prices are going to crash in 2020, 2021, 2022, 2023, 2024, 2025, it didn't happen, right? So have a working model, but we have something to work with, because that happened in 2005 to date, in the inventory channels and the distress sales, all these things. You work it all together. There you go. That's why it's a difficult problem to solve.
Difficult problem to solve. And we are happy for any of the inventory that we have in 2025. Good. The two best stories for 2025 so far, I will just summarize: mortgage spreads.
Hug a mortgage spread. Hug a mortgage spread
and housing inventory.
Inventory. Yeah. Inventory is still, supply is the best way to deal with inflation, because in the last decade, we had 3.25% mortgage rates to 5%. We did not have home prices escalate out of control. So we had a lower rates in the last decade than we had during the housing bubble years. Now, inventory is up. Even if rates fell, we're not going to see the 10 to 15 to 20% home price gains that we saw. The supply is the best way to deal with inflation.
I love it. All right, Logan, thank you so much for joining me today. We will talk again soon.